The world of ETFs can feel overwhelming with endless options, especially for beginners or immigrants new to Canada looking to build wealth. Stick with me to discover the ETFs driving my portfolio and key options you need to know about, all with straightforward insights to help you invest confidently. Hi everyone and welcome back to my channel. If you're new to investing and curious about ETFs, what they are or how they can help you grow your money, this video is for you. I'm sharing information about some commonly known ETFs like VFV, QQQ and ZID, plus a couple of Canadian options for those interested in companies closer to home. The purpose of this video is to act as a starting point for someone just getting started. I'll break down the past returns of various ETFs, their risks, what's inside each one, and their potential. Now, this is not financial advice, just a beginner-friendly guide to exploring ETFs. So, let's get started. First up, what is an ETF? An ETF or an exchange-traded fund is like a lunchbox packed with a lot of different stocks that you can buy all at once, instead of picking individual companies. An ETF gives you a mix like the top 500 US companies or a group of tech giants in one easy package that you can trade like a stock. ETFs are great because they spread your money across many companies. So if one company has a bad day, your whole investment doesn't suffer. Others in the mix can help keep things steady. Plus, ETFs are cheaper and way easier to manage than picking stocks yourself. So you can grow your money without needing to be a stock market expert. This simplicity is why the US stock market ETFs are a popular starting point. The US is home to huge companies like Apple, Google, and Tesla that drive new ideas worldwide. Over many years, the S&P 500, a list of 500 top US companies, has grown at about 10% a year on average. That means $10,000 could grow to over $100,000 in 30 years thanks to something called compounding, where your money grows on itself. For Canadians, US-focused ETFs let you join the growth, and some are designed to even avoid the hassle of dealing with US dollars. US market is bigger and powers a lot of global progress, making it a key part of many investment plans. ETFs also save you money compared to mutual funds, which is awesome for new investors. Every fund charges a small yearly fee called Management Expense Ratio or MER. Mutual funds in Canada often charge 1.5 to 2%. So on a $10,000, that's $150 to $200 a year. Whereas ETFs, they are just usually 0.1 to 0.6%. So $10 to $66 for the same amount. Over years, saving those fees adds up to thousands, letting more of your money grow, which is a huge win for building wealth over time. Getting started with ETFs is also easy, even if you've never invested before. You can open an account with a low-cost platform like Wealthsimple or Questrade and use a TFSA or RRSP account that helps keep your taxes low. Connect your bank account to add money, then search for an ETF ticker like VFV. You can start with just $100 and set up automatic monthly buys to spread out your purchases so you don't worry about prices going up or down. The key is to think long-term here. Aim for 5 to 10 years or more and don't check prices every day. Now this is just one way to do it, but it's a simple way to keep things stress-free. Now let's check out some ETFs that could be a starting point for someone new to investing. I'll share how they've performed over the past 5 and 10 years, what risks they have, what's inside them, and why they might grow over time. First is Vanguard's S&P 500 Index or VFV. It follows the top 500 US companies and is set up for Canadians to avoid US dollar hassles. It holds big names like Microsoft, Nvidia, Apple, Amazon, and Meta, covering tech, consumer goods, and other industries. Over the past 5 years, it has grown over 17% a year and over 10 years about 15%. That's like doubling your money every 4 to 5 years. The stock market can dip like it did in 2022, but it usually bounces back. The US keeps inventing new things, so VFV could grow 8 to 12% a year long term, making it a steady foundation for many investors. For those who love tech, QQQ tracks the Nasdaq 100. It's packed with tech leaders in AI, cloud computing, and electric cars. It includes Nvidia, Microsoft, Apple, Broadcom, and Amazon. It focuses on companies pushing the future through tech. It has returned about 17% a year over 5 years and 20% over 10 years, which is amazing. Tech, however, can be a wild ride. 2022 was rough, and QQQ relies heavily on a few big names like Nvidia, which adds some risk. But with AI and electric cars growing fast, QQQ could soar if these trends continue, making it exciting for growth seekers. To mix in some global flavor, BMO India Equity Fund or ZID invests in India's top companies. It holds HDFC Bank, Reliance Industries, Infosys, Mahindra & Mahindra, and Axis Bank, covering banks, energy, tech, and more. It has grown about 14% a year over 5 years and 11% over 10 years, performing steadily. India's money value and politics can make it less predictable than the US, but with India's economy growing over 7% a year, ZID offers a way to tap into global growth. Now, if you're curious about Canadian companies, here are two options that pair well with international ETFs. VDY, the Vanguard FTSE Canadian High Dividend Yield ETF, focuses on companies that pay steady dividends, like banks and energy firms. It holds RBC, TD Bank, Enbridge, Bank of Montreal, Bank of Nova Scotia, all reliable names. It has returned over 9 to 10% a year over 5 years and 7 to 8% over 10 years. It can be affected by interest rates or oil prices, but it offers a 3 to 4% yearly cash payout plus 5 to 7% growth potential. Great for steady income. Another Canadian choice is XCG, the iShares Canadian Growth Index ETF, which invests in fast-growing companies in tech and other sectors. It includes Shopify, Brookfield, Canadian Pacific Kansas City, Constellation Software, and Canadian National Railway, focusing on innovation and infrastructure. It has grown at about 10 to 12% a year over 5 years and 9% over 10 years. It's a bit riskier than dividend ETFs, but less wild than tech-heavy funds. And Canada's push in energy and tech could drive an 8 to 10% yearly growth. Knowing the difference between growth and dividend ETFs helps you match your investments to what you want. Growth ETFs like QQQ and XCG focus on companies that put their profits back into growing bigger, so your money grows as their share prices increase. However, they are riskier but can bring bigger rewards. Perfect if you're aiming to build wealth over many years. Dividend ETFs like VDY invest in companies that pay out profits as cash to you every few months. They are steadier, like getting a small paycheck with less growth but reliable income. Great if you want some cash flow now. Now, choosing one depends on what you're after, growth for future wealth or dividends for stability. Plus, your age, how much risk you're okay with, and whether you need money sooner or later. This is just a way to think about it. Now remember, this video is just a starting point for someone new to investing, showing why diversification and low costs matter. Only invest what you can afford to lose, do your own research, spread your money across different markets and think long term because the market rewards patience. Drop your ETF ideas in the comments. I'd love to hear from you. Like if this video helped, subscribe for more investing tips, and I'll see you in the next one.